All right, so one of the formulas that we studied last time for market value add is given right here. So you have, what does the left part of this expression represent? This is assuming that this is the formula for market value add, assuming a company is just growing and all the sales are is the cash available to investors, then this would be the value of the company. Okay, so the entire sales in period 1 divided by WACC minus G, this would be the total value that's created. But in the real world, you have obviously value created is less than all the sales. So I'm just going to give you a quick explanation of this part of the expression. What does OP stand for? Do you recall? So operating profitability. So what's the formula for that? Let's say that this is no PAT for the upcoming year divided by sales for the upcoming year. So there's a reason why I'm putting it this way. So divided by sales into, say, sales grow at the rate G. So no PAT divided by, so is this your operating profitability? Yeah. Okay. Minus WACC. What's WACC? Your total cost of capital. What is CR? And what's the formula for that? Okay, so it is your operating capital divided by, so let's say this is operating capital, so this is all your assets, simplistically speaking, divided by sales, and then we have this 1 plus G term over here. Now look at what's happening. So this is the right side, overall right side of the expression that we are working with. Okay. So notice the denominator on both sides is sales into 1 plus G. No PAT represents your net operating profits after tax. So that's your profits. WACC into operating capital. Operating capital represents all your operating assets that you have. Okay. WACC might be, say, something like 10%. So if your operating capital is 10 million, and WACC is 10%, then the cost associated with having this operating capital can be thought of as 10% of 10 million, which is 1 million. Let's say your net operating profit is 0.8 million. Okay, is this firm creating value or destroying value? Yeah, even though on your income statement, you will see that there is an operating profit of 0.8 million, but that 0.8 million is less than the cost associated with having $10 million worth of capital. Okay, so notice then this overall expression becomes negative and market value added is destroyed. So in this scenario, if you just double sales, what's going to happen to MVA? Will it go up, down, or stay flat? It will go down. So either you shut down this unit, or better you try to do what? You can either improve your profitability, or you can see if you can somehow cut down your capital, or you can see if you can reduce your cost of capital. Okay, so this ugly looking formula hopefully makes sense now, and make sure you also, so there are, with most formulas, there are 3 things to keep in mind. This is just high level academic advice. You need to know the formula, you need to know how to use it, and you need to know how to interpret it and make sense out of it. If you do those 3 things, then in general you will do well. Okay, now let's come to, we've done all this. We have done this. This is actually we've done this, right? So your expected return on operating capital is your no PAT in the upcoming year divided by your capital at the start of the year. Okay. What is MVA? Another formula for MVA, again this should make sense, is your capital at the start of the year multiplied by expected return on invested capital minus WACC. Okay, so what is your capital times expected return? This is the overall return you are getting. Minus WACC is the cost of capital. So this is another way of looking at that same concept. Divided by WACC minus G. Here we are making a simple perpetual growth kind of assumption. Whenever you divide by WACC minus G, we are using the Gordon growth model kind of formula. Okay, so if this numerator is positive, that means we are creating value, otherwise we are destroying value. Okay, let's do this question now. A company has two divisions. Both have current sales of 1,000 and current expected growth rate of 5%, WACC is 10%. Division A is relatively more profitable with operating profit of 6% relative to B's profitability of 4%. But the capital requirement is very high, 78% for A relative to 27% for B. So now what we need to do is look at the impact of growth on MVA. Okay, so let's look at these numbers. Division A, the data on the previous page is summarized. Okay, so with Division A, assuming this situation, so with this situation, what is the MVA? Can you solve this a little fast? So what is the sales from the previous slide? So the sales equals 100,000. So I want you to do some work here. Sales 100,000, 1,000, WACC is 10%. Okay, so I'll put the numbers up here. Sales 1,000 and WACC is, what was WACC? 10%. So I want you, when you look at these numbers, do they concern you or do they seem okay? What is capital, what's CR? And it's what divided by what? Sales. Okay, so just come up with this number over here. What's the MVA in this scenario? Okay, this is what you should get. Okay, so just using the formula from the previous slide, you get minus 300. Now if marketing comes and says let's double our sales force, let's grow sales because we are losing value, what will you show them? You'll say, okay, let's say our sales go up by 20%, so 5% growth to 6% growth. Sales will be up, no PAT will be up, but when you calculate your MVA, it will be even further down. Okay, so whereas for Division B has a positive MVA. Why do you think Division B has a positive MVA even though it has lower profitability? Zarak? Yeah, its capital requirement is much lower. So the amount of money that needs to be tied up in capital is much lower for Division B. So even though it's slightly less profitable, but it's less profitable on a lower capital base. Okay, so you can add more value in that scenario. Okay, so this becomes 300, and then in this situation, if we increase sales, then what happens? Yeah, then you are actually adding value. So as long as your MVA is positive, then you can press on the accelerator and try to further increase your sales. If you are in negative MVA zone, then either you try to make yourself more efficient or you shut down that division. All right. So the question is, in Division B, if we increase the capital, but sales remain the same. Yeah, then we can do the numbers, but I think we might then go into negative MVA, because in your formula then, what is going to, in your example, if capital goes up, what will happen to this ratio? Yeah, the ratio will, in your example, this left side will stay the same. Okay, operating profitability, will it be impacted? How? Just to check. Why will it be impacted? Yeah, actually, if it depends on how exactly we define this. If this is defined as actually operating profit, it will go down because depreciation goes up. Yeah, depends on whether you're anyway, I think the quick answer is whatever the scenario, you can remodel the scenario and do the numbers again. But the big picture will be if you are using much more capital now than before and sales have not gone up proportionally, then what will happen to this ratio? This ratio will actually go, what was this ratio? It was your capital divided by sales. So if your capital is increasing a lot, this ratio is going up. So this whole number is going up, and that means this whole thing is coming down. Okay, so that's the answer. Okay, now let's do an analysis of growth strategies. The expected return on invested capital of division A is less than WACC, so the division should postpone growth efforts until it improves the expected return on invested capital by reducing capital requirements and or improving profitability. The expected return on invested capital of division B is greater than WACC, so the division should continue its growth plans. Okay. Now we are changing gears. Okay, we are going to talk about carrots and sticks. Okay, or another way of putting it, we are going to talk about corporate governance. Now, if you are thinking right now, then you would be thinking to yourself, what does corporate governance have to do with this chapter? Okay, now just to check how much you are thinking and how much you are aware of where we are. Okay, so what chapter are we on, Serish? Okay, what is this chapter supposed to be about? Okay, so what do you think corporate governance has to do with corporate valuation? Omar or Fuad? Anybody? This is actually a tough one. So what does corporate governance have to do with corporate valuation? Okay, so good. So you are talking about corporate governance, but the question, so you know basically what have you interacted with corporate governance in the past? In what course? Oh, you studied corporate law. In which corporate governance? Okay. So then for those who have not, I'll just summarize what corporate governance means, and then we will see what does this have to do with corporate valuation. So in simple terms, the definition of corporate governance is it's the rules and regulations of a company that allow the management of the company to work in the best interest of the owners. Okay, who owns a company? The shareholders. Who represents the shareholders? The board of directors. Okay, so ideally the shareholders elect a board of directors, where board of directors are people who are also maybe big shareholders. They represent the entire shareholder community, and that shareholders community represented by the board of directors own the company. For large companies, they don't run the company, they just own the company. Who runs the company? Management. So if you have a separation of ownership and management, there needs to be a set of rules and processes and regulations so that the company is being run in the best interest of the owners. That set of regulation or those rules, procedures, guidelines are called corporate governance guidelines. Okay. Now, what does this have to do with valuation? So, right at the back, your name, next to Azza. Actually, all companies would like to increase their value. Okay, assuming for a moment that we are all ethical around here. Okay, it's a tough assumption, but let's make it. Okay, any other? So, in general, any thoughts on this? Okay, yeah, good. Actually, this is a tough one. I think let me just summarize this. The whole point is We talked about this concept of value-based management earlier. That was nicely being read out from the notes. Okay, so value-based management is this whole management philosophy where you want management to act in a way to maximize the value of the firm. Okay, maximizing the value of the firm, is that synonymous or analogous to saying that you want to increase market value add? Right, so they are really effectively the same thing. So ideally, you want a corporate governance charter that is designed so that management acts in the best interest of owners. And what does it mean to act in the best interest of owners? They need to do whatever they can to maximize the value of the firm. So that's where corporate governance comes in. If you look at a corporate governance charter, the way you should analyze whether it's good or bad is whether this is encouraging management to operate in the best interest of shareholders. Now, very broadly and very simplistically put, there are two kinds of rules, okay, or two kinds of setups. And actually this ties back, I don't know if you've taken any courses in psychology, but people do things for two reasons. Either they do it to get some form of pleasure or get some reward. Achievement is, one way of feeling good, which is a form of reward. Okay, that is symbolized by the carrot. Or people do stuff to avoid pain, which is symbolized by the stick. So most corporate governance rules can be either in the stick category or in a carrot category. What is the most basic? Most people, at least in our country, understand the stick better than the carrot. Okay, so what in the stick category, what's the most basic stick that management would be worried about? Getting fired. Okay, if management is clearly doing something that is not adding value to the shareholders, then the stick is that he'll be fired. Okay, then there would be lesser sticks such as not being promoted or not getting a raise or other punishments like that. And the carrot, what would be just to check your basic understanding? So perks, benefits, raises, options, etc., etc. Okay, so that's the high level. Okay, now getting into some subtleties, one of the issues that owners might have is with the concept of entrenched management. And we need to have rules that avoid the problems associated with entrenched management. First question is, what does entrenched management mean? Turab? Basic English, what does to be entrenched mean? Yeah, not irreplaceable. Entrenched means that you are like embedded and you are sort of either stuck there or you are just there. For example, what is the most classic example of a entrenched situation? You might take a bureaucracy, a civil bureaucracy. If you have a guy who is working in a given government office and he knows that nobody can fire him for whatever reason, does he have any incentive to do a good job? Yeah, very little incentive to do a good job. Similarly, if in a given company the management is very comfortable that nobody is going to fire me, okay, I'm just here for life. Okay, does he have an incentive to maximize shareholder value? No, he has an incentive to coast, right? So it's like, just take it easy, and if there is so that's the issue with entrenched management. So occurs when there is little chance that poorly performing managers will be replaced. Now in the corporate context, when does entrenched management, when does this sort of a situation happen? If the corporate charter makes it very difficult for takeovers. What does that mean? Okay, so what is a takeover? This is where a given company is taken over by another company. Some of you, like Amit, who took part in the recent event, know all about takeovers. Okay, so in a takeover, would an entrenched management worry about takeovers? They would, because in a takeover, what happens? You have company A, which is performing poorly. It's run by these poorly performing managers. Okay, it's taken over by a large company which believes it can improve the performance of this company. what do you think the first thing that big company will do? It will fire these managers. So these managers have an incentive that the corporate charter should be designed such that they make it difficult for takeovers. So anti-takeover provisions in a corporate charter are generally bad. Does that make sense? They are bad for whom, actually? They are bad for the management or bad for the owners? Shareholders. If this company were to be taken over, would the owners of this company benefit? Typically they would, because when there is a takeover, the target company stock price typically goes up. That's one point. The other related point is that if this bigger company can take over and make this company more efficient, won't shareholders be happy? Wouldn't their value go up? So in general, having rules that make it easy for a takeover is good for owners. Having rules that make takeovers difficult is bad for the owners of a company.
What could what could that be?
What could what be?
Making rules difficult.
Okay, that's what we are going to talk about. Okay, so there are these things called anti-takeover provisions, which we will talk about. And another issue is a weak board of directors, okay, which we'll talk about. Okay, so now a basic question is, how are entrenched managers harmful to shareholders? Is it obvious? So yeah, they are expensive. They would, if you know that you are not going anywhere, you will try to maximize your salary, maximize your perks, make sure you get membership in the best clubs, get, trips for your whole family and so on. And this does happen, right? So if management is sure that their jobs are secure, they can do things that do not add value to the firm. And if they are not adding value to the firm, then obviously that means MVA is coming down. That's one category. Another category is where management might take on low or negative NPV projects just to make the firm bigger. Have you noticed that people who are working at larger companies, so if you are the big boss of a big company, you tend to be making more money than if you are the big boss at a small company, right? Typically that's the way the world works. If you are the big boss of a big company, you make more money than if you are the big boss at a small company. That's just the way it is. What? Yeah, at a not so big company. Okay, so very, very roughly speaking, the bigger the company, the larger the salary of the senior management. Okay, so if you are at a medium-sized company, one way to increase your salary is to do more projects and become bigger. Okay, but is that good for shareholders? Not necessarily. It's only good for shareholders if the projects that you are doing are positive NPV projects. Okay, so anyway, the management incentive then would be to simply become bigger, whereas the owner would want that only positive NPV projects be done. So this is another possible issue. If you are entrenched management, then you might just become bigger for the sake of becoming bigger, without becoming more market value added. All right. So now, what are some anti-takeover provisions that we need to be careful about? Because if we can get rid of these anti-takeover provisions, then that would make our corporate governance charter better. Okay, one item that has existed historically is this thing called targeted share repurchase or green mail. So let me explain how this works. And the point is that this is bad. We should try and not have it in our charter, but management would like to see it. So the way this works is as follows. Let's say that you have this small company that is being run by a team of inefficient managers. Okay, and let's say that currently the share price of this company is $20. Okay, now you have this other group of investors who believe that they can take over this company and make it perform much better. Okay, so these are investors, either they can belong to a big institution or wherever, but these guys know what to do to make this company much better. So what they start doing is they start buying shares of this company, and let's say that these guys have built a 10% ownership of this company. Now, do you think these managers here will start getting worried that if this company, if these managers fear that the investors will just take over the company, okay, what's the worry that this entrenched management team will have? They'll get fired. Okay, so these guys smell something bad happening for them, so they send a letter which is called the green mail. So they send a letter to these guys saying that, look, you've bought 10% of the company already. What we will do is we'll buy these shares back from you for $30. Okay, so this is like a bribe, okay, because they are buying back a $20 share for $30 using company money, shareholder money, and in return they are telling these investors that, look, we will buy shares back from you at a 50% premium if you promise not to take over. Okay, if you promise not to mess with us again, not to buy any more shares of this company again. Okay, I'm just making it slightly more extreme, but that's the principle. Do you see why this is green mail? Do you see why this is like a bribe? And it's not even using your own money to bribe, it's using, the management is using shareholder money to bribe. So they are using shareholder money to buy back a $20 share for $30. So now there are two parties that benefit through this and one big party that loses. The parties that benefit are obviously these investors. They are getting more money. These managers, because they get to keep their comfortable jobs. And the party that loses is these quiet majority shareholders, because it's their money that's being used to do this. Okay, now do you think green mail should be allowed? It should not be allowed. Okay, so the fancy word for green mail is targeted share repurchase. Can you see why it's called targeted share repurchase? Because there's a targeted repurchase only from people who might be taking over the company. What would the owners of this company like? Yeah, what would the owners of the company prefer?
Like anyone can buy the shares.
Exactly. The owner of the company would like that whoever can come in and maximize the value of the firm should take over the company. End of the day, when you own a share, what are you concerned with? The value of that share and dividends. It's what's in it for you, right? You're not concerned with management, as long as all you want is that the management that works for you does a good job and maximizes the value of the firm. Okay, so that's one item. So this is one anti-takeover. So if you have this provision, have a green mail provision, that's considered a. So this is one example of an anti-takeover provision. Okay, another one is a shareholder rights provision, sometimes also called a poison pill. Now these things have a lot of detail behind them. At our stage right now, all we need to do is understand the basics. Okay, so this provision says that so this might be a provision in the corporate governance charter, which says that the target firm shareholders can buy shares at very low prices. So what this means is that the target firm is the firm that's being taken over. So if there is a provision that says that the people who work or the shareholders or management of the target company have a right to buy shares at a very low price if a takeover takes place. What does this mean? This means that any entity that's trying to take over is going to be worried about dilution. So if these guys are buying shares for, let's say, $20 per share, but if the existing owners have a right to then get new shares for only $10 per share, okay, so if this rule allows only the existing shareholders to get new shares at half price, what does that do to the company? It dilutes the value of the share. Now, if you are coming in and you know that as soon as you come in and pay $20, the value of the share will be diluted because the company will issue many more shares only to existing shareholders at half price, would that encourage an outside entity to take over, or will it discourage? This would also discourage. So this is another example of a anti-takeover provision. Okay, so actually there is, I'm simplifying this. I don't think, you don't need to understand the detailed mechanics of this. the way you can think of it is very simplistically, these guys have offered to pay 20 based on market prices. So they've made that offer. And after that offer, the shareholders have a right to issue new shares at a lower price. So in essence, the earnings per share and so on will become less.
Why would
Now,
shareholders do that?
why would?
Shareholders.
The existing shareholders?
Yeah.
Exactly. My point is this should not happen. So the reasons,
Benefit for that, like
what's the benefit to whom? To the which shareholder? The one taking over or the ones who are existing? The target.
shares right after the
The target shareholder, the benefit to them would be they would get many more shares at a relatively low price. Okay, so again, don't get too hung up with the mechanics of this, because that's a much more detailed exercise that we don't need to get into right now. All you need to know is, if you have something like this where the target company has a right to issue more shares at a low price only to existing shareholders, then that also discourages an external entity from taking over. And then finally, there is another item. Actually, there are many more. I'm just giving you the top three. Restricted voting right plans. So this is saying that if a given shareholder, for example, has more than 25% ownership, then his voting right becomes restricted. So he then, for example, might not be allowed to vote for a new board of directors. Okay, so is this a problem? It is a problem, because it's encouraging a new entity coming in, taking a large ownership stake, and then voting to bring in a new board of management, a board of directors. Okay, so that's another issue. Okay. The other category that is associated with weak corporate governance is having a weak board of directors. Who are the board of directors supposed to represent? They are supposed to represent shareholders. Now, if the board of directors is primarily friends and family of existing management, then who would they be closer to, management or shareholders? Management. So the image that you can keep in mind is, for a given company, here are the small shareholders. They are supposed to be represented by the board of directors, and then here you have company management. So the board of directors sits in between. The board of directors is supposed to represent the shareholders, best interest of the shareholders, and keep an eye on the management to make sure management is doing a good job. But if you have board of directors where the CEO of the company is also the chairman of the board, which does happen a lot, but is against corporate governance best practices. Let's say the CEO, the CFO of this firm is on the board of directors. The former CEOs, who are buddies with the existing CEOs, are also on the board. Okay, then we have a weak board. A weak board is a board that is too close to management and not representing the best interest of the shareholders. Do you think such a board will crack the whip if management is doing something wrong? No, so that's an issue. Weak boards may have insiders. Who are insiders? Yeah, so insiders would be either people who are closely associated with the company, or maybe friends, family, relatives of the company management. You can also have a situation called interlocking boards. So they are also weak, where the CEO of A sits on the board of B and vice versa. Okay, so then you have a you scratch my back, I scratch your back scenario. Okay, so I am on the board of the company where you are CEO, so I won't bother you. But guess what? I am the CEO of this other company where you are on the board, so you don't mess with me there. Is this conceivable?
Yes.
It's quite conceivable, because in most countries you have an old boy network. Okay, they meet at Sim Club, they have lunch together, and they are, running their respective companies and sitting in their comfortable board seats. And, it's a nice, happy setup. Okay, so it does happen. All right, but it runs counter to corporate governance best practices. Value is not being maximized this way. Okay, so we've talked about issues. Now, what is the carrot-oriented approach? There are several carrot-oriented approaches. Some that we've already talked about. If, as a management, you do a good job, you get raises, you get bonuses, and so on. Okay, one way of aligning the interest of management with with the shareholders is to give stock options to management. Stock options would mean the following. Okay, so I'll actually give you a simplistic example from my past in terms of exactly how this worked. Okay, so in about 1999, I joined a small startup company in New Jersey. Okay, so they gave me stock options which I could exercise over a 4-year period. The point being that, let's say for every 100 options that I got, I had the right to convert 10% in year 1, then 20% in year 2, 30% in year 3, and then the remaining 40% in year 4. So this meant that if I had 100 options, option meant that I had the right to buy the share of the company at a very low price. Okay, so what does this mean? So what is the incentive to me? The incentive to me was to work really hard so that the share price goes up. I know that I can buy the share, I will get the share for $1. Okay, that was the option I had, the option to purchase the share for $1. Now, if I and all my colleagues working at the startup could boost the value of the firm, then any increase in the value of the firm would also benefit us. So do you see how the incentive of the owner, what's the incentive of the owner? To maximize the value of the share. That is aligned with the incentive of the management. So by giving options, you do that. Now what if I had an option where I could exercise everything right up front in year 1? Then what would happen? Then what I could do is I could just exercise all my options in year 1 and be gone. Okay, let the other guys work hard and let the share price go up. Yeah, or do something real quick to make things look good in the short run and then get out. Okay, so that is why when companies give options, they have a long vesting period. Vesting period means that, okay, I have the option, but I can only exercise it after 4 years. So that means I need to slog for at least 4 years, right? Get the value up, only then can I leave. Okay, so now I'll just read the text. Gives owners of option the right to buy a share of the company at a specific price called the exercise price, even if the actual stock price is much higher. So the incentive to the management team is to make that actual stock price higher, because any difference between stock price and exercise price goes to my pocket. Usually can't exercise the price for several years, called the vesting period, and hopefully you understand the logic of this. Okay, can't exercise option after a certain number of years, called expiration, so you just can't sit on it forever. Okay, and we'll study this options later in the course.